Thank you. Hi, good afternoon, everyone. Good afternoon. How are you feeling? Great, wonderful. Hope you had a good day so far, and thank you so much for being here. I'm Adam Koo, and I'm here to do a short presentation on how do you achieve consistent profits investing in the stock market, so you can achieve your financial goals and build your wealth much faster than ever before. Okay? Now, before I start, I've just got one small request, that for you to maximize your learning and to learn as much as you can in this short time, please participate in this presentation. Is that okay? Thank you. Singaporeans must ask them to participate. If not, later they stare at you. Okay. So along the way, I'm going to, ask questions. So when I ask questions, please raise your hands to give me your response. Okay? Because all of you have different opinions, and your response means a lot to me. Is that okay? Great. One last thing is, when I talk, sometimes if I say something which I think is worth remembering, I may ask you to just repeat what I say. So if I do that with all your energy, guys, in the afternoon, please repeat what I say. Thank you. Then I know you're still awake. Thank you. Okay. So I'd like to start off with this question. Is Singapore an easy place to become a millionaire? Okay, so let's do a vote. Yeah? In Singapore, voting is compulsory. Who says yes? Okay, I see about half the room. Who says no? How many of you don't care? Okay. Now, statistically, Singapore is the easiest place in the world to become a millionaire. According to who? Not me. Okay. According to the Boston Consulting Group, one of the top research firms in the world. And for the last 4 years, they do a global wealth research. And they found that Singapore has been ranked number 1 in the world for having the highest percentage of millionaires in its population. And this was back in 2011, this article, right? Singapore leads the world in millionaires. In Singapore, 15.5% of Singaporeans are millionaires. 15.5%. Interesting, right? How do you define a millionaire? Someone with over US 1 million in investable assets excluding their property. It means excluding property, 15.5% of Singaporeans have US 1 million. That's 1 in 6, the highest in the world. Now, that was back in 2011. 2012, was it higher or lower? Even higher. Take a look. In 2012, the Straits Times report 17% of Singaporeans are millionaires. 17%. All right? Compared to the US, only 4.5%. Hong Kong, only 9%. We are triple that of the US. And not only that, but the Straits Times reports that the number of millionaires in Singapore is to what? At least double by 2016. Now the question is, if you study people who make millions in Singapore, where do they make their money from? Stock market, property market, so on and so forth. In other words, here's the answer. Business Times tells you the answer, right? It is the investment gains that's creating many more millionaires. Which means if you want to be a millionaire to be financially free, you have to invest successfully. Okay. So the good news is Singaporeans are getting richer faster than anywhere in the world. But what's the bad news? This is the good news. There's a bad news to it. Okay, good. The bad news is it is only the rich who are getting richer. And the poor who are getting poorer. That's right. And the income gap is rising. It is only those who are financially savvy, who know how to take advantage of the financial system, these are the guys getting richer. Those who depend on salary are getting poorer. For a very simple reason. Because salaries cannot keep pace with inflation. And that's the reason why. So if you read this article on CNBC, it says Singapore's fast growth is creating what? The rich and poor divide. So a lot of people are unhappy in Singapore, right? If you see this slide, it says what? Oops. It says, it's unfair. I'm a Singaporean and yet I'm not benefiting at all from how rich Singapore has become. Why? Because these people only depend on a salary. They don't know how to invest. So they can never get financially successful. If you read below, it says this. Government data showed last year, the bottom 10% of Singaporeans earn $1,004 a month. Compared with the top 10% that earn what? $23,000 a month. And here's the interesting thing. Did you know that Singapore has the second highest what? Income gap among 42 nations. We've got the second highest income gap in the developed world. Right? So is there a need for us to learn how to invest in Singapore? Yes or no? Yes, if not, you become the bottom. Okay. Right? So why invest? Why invest, right? For a very simple reason. Two reasons why you must learn to invest. First reason is to maintain our standard of living. It's not about raising the standard of living. No. First must maintain first. Why? Because again, cost of living is rising faster than what? Salaries. If you just depend on salary, you're getting actually poorer every single year. Yeah? Second reason is to go one step further. You may say, I'm not just satisfied maintaining my standard of living, but you know what? I want to be what? Financially free, to not be in the rat race like a hamster. Okay? Now, how do you become financially free? Which means you have the choice. Everyone say the word choice. To not work and be able to what? Pay your expenses for the rest of your life. How much do you need in order to achieve that in Singapore? A lot. Okay. The answer is it depends on your lifestyle. Right? If you've got higher expenses, you need more, yes or no? If you take a financial calculator and do the sums, here's the answer. Okay? Assuming now you're 40 years old, I'll just make an assumption, and assuming that you die at 80 years old. Okay? And assuming our inflation rate is 3%, which is actually a bit more. Okay? Now, if you make these assumptions, if you calculate, you find that to maintain a 5,000 a month lifestyle, you have to accumulate 3.63 million in order to retire in Singapore. To maintain a $5,000 a month lifestyle. Now, if you have a higher lifestyle, like 8,000 a month, okay? Got bigger house, bigger car, bigger wife, okay? Then you will need, statistically, right, 5.8 million in order to be financially free. So question, from where you are today, can you build 3.63 million? Can you build 5.8 million? Can, if you know how to get your money to grow faster than most other people. Cannot if you don't know how to do that. So if you take a look at this graph, now, assuming you save $800 every month. By the way, any of my guys around, can you help me to pick up my markers? It just dropped down, thank you, okay. Now imagine if you save $800 a month. In other words, husband and wife both work. Let's assume wife earn 4K, husband earn 4K. So total earn how much? 8K. And most people will save at least how many percent of their income? At least 20% because of CPF. But let's say out of the 20% you save, 10% you save to buy new car, go on holiday, give to City Harvest, church, whatever. So let's say you got 10% left. Okay, now what's 10% of 8,000? 800. So I assume the average household can save 800, fair enough? Okay, so if you save 800 a month, and your money is growing at 5%, okay, which is what most whole life endowment policies with some unit link give you, right? Then after 20 years, you only got 342,000. Is it anywhere near the 3 million? You can never retire. You work until you die. Now, if your money can grow at 8% per year, it becomes 484,000. Also nowhere near there. If your money grows at 15%, not bad, you end up with 1 million, but still nowhere near the what? 3 million. But if your money can grow at 24% return compounded every single year, then you gum ho, just nice, make the 3 million. Then the question is, are you able to achieve a 24% return compounded on average every year? Yes or no? Who says yes? Who says no? Who says it depends? It depends on your investing skills. If you're like most people with no investing skills, only know how to buy and hold, or buy the most stupid thing, then of course not. But if you learn how to invest actively with the right strategies, is that possible? Of course it's possible. Okay, later I'll show you my own portfolio. I'm returning over 50-60% every single on average. If I get less than 30%, I slap myself. But then I spend a lot of time investing. So you can learn these skills. Okay? So how do we achieve that kind of high rate of return? First, let's take a look at this. Let's look at the different investment vehicles and the returns they have produced over time in the last 30 years. Okay? Now, whatever we want to do, we must at least beat what? You've got to beat, at least beat inflation. So, fixed deposit is important. You need that for what? Security and liquidity. At least put, maybe 3 months of your savings at least there, just in case. But if everything is there, what's happening? Your money can't grow, yes or no? You're actually losing about 2% plus a year in inflation. If you compound that to 20 years, that's a 40% fall in your real wealth. Okay? Now, gold. Is gold a good investment? Gold has been a great investment in the past, during the crisis era. And gold has produced an average of 7.6% compounded annual return. However, some of you may know that gold right now has just gone into bear market already. Gold is at the beginning of a huge downtrend. In my program, I'll explain why it's happened. And gold has basically, the bubble has burst already. Right? That's why all these gold schemes have all collapsed recently. Yeah? Bonds. Bonds produce on average 6.4%. Property. Not bad. Based on the URA price index, property has compounded annually in the last 30 years, 10.85%. Not bad, right? Okay, lah. How about US stocks? Now, before I show you that, right, let me just show you this article first. Okay? How many of you are invested in gold? Be careful, okay? Gold doesn't go up forever. Gold is very cyclical one, okay? As you can see, gold, like any other commodities, goes through bull cycles and bear cycles, okay? The price of gold in 1980, that was a long time ago, right, was $800 per ounce. Then from 1980 to the year 2000, how many years? How many years is that? 20 years, gold went from $800 to $280. It was a 20-year bear market. Now, why was gold crashing? Because economies were recovering. See, gold is the inverse of economic growth. When economies are growing, people dump gold and gold collapses. In times of crisis, people scared they buy, gold as a safe haven and gold goes up, understand? So you notice, in the year 2000, what happened? .com crash, remember that? Hey. Then in 2007, US subprime mortgage, crisis. 2010, European debt, crisis. You had 3 major crises. And all this fear fueled the gold rally. So gold, until 2009, sorry, right? What do you call a graph that goes like that? It's called a hyperbolic graph, which means 90 degrees. Now, if you study history, anything that goes hyperbolic, from the tulip mania to dot-com bubble, it crashed at least 50% after that. That's why I say be careful of gold. And I'm not the only one saying that, right? If you listen to our good friend, I'll show you that later on, that major banks are calling for the gold bubble to finally burst, right? And right now, gold is in a bear market. Have you heard of George Soros? He's Mahathir's good friend, right? And George Soros called gold the ultimate bubble, right? He recently just sold all his gold already, yeah? So that's gold for you, yeah? It's a bit scary. Now, property. Property is a great investment. And we know that eventually, will property prices rise in Singapore? Of course, because 6.9 million, you have to what? You have to drive up property prices, right? But property doesn't go up in a straight line. It goes up and down like anything else. Now, if you take a look at property, this is the property chart based on the property cycle, right? And you can see that in 1997, we peaked. Once we peaked, we collapsed 45%. Remember that? Back in 97, right? Then we had a little now peak in 2000, and then it collapsed 22%. Then we peaked in what? 08 and what? Collapsed again during the financial crisis. So every time we make a new peak, what happens? We collapse about 40%, 20%, 28%. Where are we now? We're now here. What goes up must come down. And that's why, for me, property a bit scary now. Okay. Now, not only that, if you read this article, right, our good friend Taman say what? Property prices not yet at an acceptable level. You know what he's telling you or not? He's telling you that property prices are not acceptable. In other words, the government is going to do whatever they can to make sure it does not go up now. And that's why I will not invest in property now, in my opinion. Okay? Now, and that's why I love stocks. Now, let's compare it to the stock market right now, right? The US stock market in the last 30 years has compounded annually at 12.33%. Everyone repeat, so you remember? 1, 2, 3? Let's do that one more time. Together. Ready? 1, 2, 3? 12.33. Okay, good. Singapore's stock market in the last 30 years has been a bit lower, 10.15%. Ready? 1, 2, 3? Okay. Hong Kong market, not too bad. The Hong Kong market has given 13.14% return. And the Jakarta stock market has been the fastest growing market in the last 30 years, growing at 15.87%. Okay? So if you take a look, right, which asset grow your money the fastest over the long term? Stocks. Stocks. Because stocks are companies. And companies grow faster than real estate and commodities and bonds over the long term. Make sense? Okay? Now, specifically, if you take a look at this, 2 things to understand. Number 1, when we say that Singapore stocks grew at 10%, right, compounded annually, right, does it mean every year it goes up 10% sui? No. The market is very volatile. Now, on a bad year, the Singapore market can drop 60% in 1 year. This was back in 2008. On a good year, the Singapore stock market can go up 100% in 1 year, back in 2010. So what does this 10% represent? The average over that 30-year period. Are you with me so far? It's the average, not every year like that, but you average out. Now, does it mean that any stock you pick will give you this average return? No. If you pick the wrong stock of the wrong company, it can drop and never come back, like Costco, Raffles Education, okay? But if you pick the right stock, like BreadTalk, Supergroup, the burger can go up what? 600-700%. OSIM up 1,000%, right? So, which stock does this represent? Which stock in the market? Yes, it represents the blue chips, or the largest stocks in the market, right? So, and it makes up what we call the index, yeah? How many of you know what is the index? I need to know. How many of you don't know what's the index? All right. Now, what is the index? The index is used to measure the performance of a stock market. Okay? And the index is made of what? A basket of the largest stocks used to represent the entire market. So in the US, example, there are about more than 10,000 stocks that you can buy. But out of the 10,000, they pick what? The 30 biggest stocks, called the blue chips. Example would be your Microsoft, your Intel, your Cisco, your United Technologies, your Walmart, your Pfizer, okay, your McDonald's, your PepsiCo, your Kraft. You know that? Walt Disney, the 30 biggest. Take the average price of those 30, what do you get? You get the Dow Jones Industrials Average Index. Have you heard of the Dow Jones? So when you hear the Dow Jones grew at 12%, it's not every stock. It is the what? Average of the 30 biggest. Make sense? Now, how about Singapore? How many stocks are there in Singapore? 800. 8 to 900 lah. Out of the 800, they pick what? Again, the 30 biggest, right? UOB, OCBC, DBS, the three banks, right? Then the telcos, right? StarHub, Singtel. Then you got what? SIA, and then you got ST Engineering and all those things, right? Take the average price of the 30 stocks, what do you get? Straits Times Index. Are we with me so far? Okay, so all this basic stuff, you all should know this, right? Okay, now based on this, how do we make money from the markets? Right? So I'd like to ask you a question. Let me skip all this first. Show this ready. Show this ready. Show this. Show this. Okay. Question. Is it possible to earn a 10 to 13% annual return without picking a single stock, almost risk-free? Yes or no? Again, let's do a vote. Please vote at least one time. If you don't know, just guess. Okay, who says yes? Who says no? Who says I don't know? All right. Now, I'm not going to tell you the answer. I want you to answer the question yourself. So I'm just going to show you the facts and figures, and you tell me whether it's correct or not. Okay? So first, I'm going to show you what? History. Let's take a look at history. This is the last 30 years performance of the US stock market. Represented by the what? The Dow Jones Index. So notice that the stock market, in the short term, is very what? Volatile. It's like a roller coaster. No? Every time it goes up, it must come down. Every time it goes down, it must go up. It's called the market cycle, right? So if you take a look over here, can you see? Go up, come down, 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 go up. So although it keeps going up and down, up and down, up and down, but over the long term, it keeps what? It keeps trending higher. Over time, it makes higher highs and higher what? Lows. Make sense? So let me ask you this. For the last 20, 30, 40 years, the index always ends up higher than before, right? So question, 10 years from now, 20 years from now, would the index be higher than today? Yes or no? Yes or no? Yes. How you know? How you know? Why history? History can change what? What makes you think it must always go up? Huh? The answer is it will always go up. But the question is why? Logically, why? Why can't it come down? Yes, correct. Because of the one, inflation. You see, I think logically, let's say out of the 30 stocks in the Dow Jones, right? One of them is, let's say, McDonald's. Do you have McDonald's in Singapore? Malaysia? India? Hong Kong? Africa? So although it's a US stock, they don't only sell to the US market, they sell to who? The entire world. Okay? 10 years from now, would a Big Mac be priced higher than today? Of course, guarantee. So even if they don't sell an extra burger, but because each burger is priced higher, right? Their total sales revenue will be what? Higher. Their net profit will be what? Higher in dollar-adjusted terms. Hence, the value of the company will be higher in dollar terms. Hence, the stock price will adjust to the inflated value. Make sense? Okay, very good. Second thing, 10 years from now, would there be more or less people in the world? Why more? Because more people are born than people die. And people are growing older and older. So if more people in Singapore, Malaysia, Hong Kong happen, right? More people will buy more Big Mac, more ice lemon tea, more French fries. So McDonald's has to just keep what? Growing to feed more people. And that's why the company will just keep growing. Make sense or not? Now, reason number 3. The 30 stocks in the Dow Jones or STI, are they always the same 30? They change all the time. The moment one stock is no longer the best, it gets kicked out of the index. Replaced by what? The next better company. So if one day you all hate McDonald's, they will kick out McDonald's and put in Burger King. You get the point? No? So it is always the what? Best 30 in the market. And that's why the index will always go up. So as an investor, the first thing you must understand is this. The index will always go up over time. Can you repeat? The index will always go up over time. A stock can drop and never come back, but the index will always go up. So imagine, in 1980, you bought the index, the Dow Jones index, right? And you close your eyes. Go up and down, you don't care. Hold for the long term. And today you open your eyes. Would you make money or not? How much you make? You make the gradient of this line, which is equivalent to a 9.33% capital gain and a 3% average dividend yield, which amounts to 12.33%. You get the point now? Okay. Now let's look at Singapore. Singapore is even more volatile than the US, you know. It's super roller coaster, like Battlestar Galactica. Right? So, imagine if you bought the Singapore index and you don't know when to buy, you just hantam. And let's imagine you're really sway, which means you're damn unlucky. La. And imagine, right, you bought here. You bought in what? You bought in 1998 at the top of the market cycle. Now, if you bought here at 2,500 points on the STI weapon, oh my God! In 3 years or 2 years, it dropped to 1,900 points. So, what? That's more of a 60% drop, yes or no? Correct or not? So, it's investing risky, yes or no? Yes or no? Yes, if you sell here, who the hell asked you to sell there? If you know that the index will always go up, what do? Yeah, double up. Okay? A whole at least, right? And if you double up a whole, guess what? Within what? About 2 years, you make everything back. Plus a profit because you doubled up. But if you don't know how to get out and you keep holding you, oh my God, again, oh, Sienna. But you say, what goes down must come up. Close my eyes. And show, oh, you see, multi-millionaire, walao eh. Hey, from here to here, how many times? 400% return, no. But again, if you don't know how to get out and you keep holding, oh my God. Sorry. I got too excited already. I love to give this talk, it's so interesting. Okay, but you don't know how to get out, you, oh my God, but then I close my eyes, you'll come back, oh yeah, coming back. Yeah. Now we're here. Can get heart attack, no? Can get heart attack or not? Can get bloody heart attack, right? But if in 1980 or 1990 or the year 2000, you bought the index of Singapore and you close your eyes. Go up and down, you don't care. Hold for the long term. Today, open your eyes. Would you make money? How much you make? You make the gradient of this line, which is equivalent to about a 10% compounded annual return, including dividends reinvested. You get it for me? How about Hong Kong? It's the same thing. In the short term, it go up and down. Hold long enough, it always go up, always make money. 13.84%. Don't know why they talk like that. Eat too much dim sum already. Jakarta. Take a look at Jakarta, man, happening, no? The last 15 years, Jakarta, if you buy and close your eyes, compounded annual return 17.67% over the last 15 years, and over the last 30 years, it was about 15%. So, based on what I just showed you, is there a way to confirm, sure make money from the stock market? Yes or no? Yes. By buying what? By buying the index. By simply buying the index. But the index always goes up. Now, how many of you know you can buy the index? I'm just curious. Okay, not too bad. How many of you didn't know you can buy the index? How come you don't know? Now, if you don't know, you know why? Because no one taught you. Because you go to school, they don't teach you all these things, yes or no? They teach you just to get a job and get broke. They don't teach you how to get rich. But if you knew that you could buy the index, question, and if you learned this many years ago, today will you be much richer? Of course. That's why the difference between the rich and the poor in Singapore is not intelligence, it is not luck, it is financial knowledge. And that's why I'm on a mission to empower people with this knowledge so that everyone can learn the right tools to create wealth. Okay? Now, how do you buy the index? How? Yes, you can't buy the index directly. You have to buy the index using an ETF. Have you heard of ETF just now? Did people talk about ETF just now? Not yet, Ayo. Okay. I was one of the first people to talk about ETFs about 11 years ago. You know, there's this thing called the SGX magazine, Pulses. I was on the front cover 10 years ago. And I was the first guy to talk about ETFs in Singapore. All right? Don't believe, go and check. Anyway, so you buy index using what? ETFs. Okay? So, first lesson you learn, you can make a 10 to 13% annual return because that's the average return of the index, right? But with little risk by buying and holding the index for the what? Long term. For example, how many of you believe in Singapore? Do you think that in the next 10, 20 years, Singapore will continue to grow and grow more than today? How many of you? Even after Lee Kuan Yew died. Okay. So if you believe that, you buy what? The Straits Times Index ETF. How many of you believe in China? You think eventually China will be the world's biggest economy? 中国! Stop coming, look at me. So if you believe that, what do you buy? Shanghai Index ETF, Hang Seng Index ETF. Right now, Europe is in a big mess, right? The crisis, all that. But how do you think eventually they will recover and get back to where they were? So you buy the European Index ETF. You get the point? All right? Okay, good. Now, I know some of you are thinking, Adam, but 10 to 13%, not exciting, right? But better than your fixed deposit, right? Better than your CPF, right? Better than your unit trust, right? Do you know something? A 12% annual return will make an average person a millionaire. Do you know that? With enough time. The average person earns 3K a month in Singapore. Can we say that to be fair about that? So the average person makes how much? 36,000 a year. The average person will work 30 years in their lifetime. So 30 times 36,000 is what? 1 million. No? Now, what does this mean? It means to say the average person in Singapore will make $1 million in their entire lifetime. All of you here will see 1 million pass through your hand, yes or no? But after all your hard work, right, will you have the 1 million? What happened to the money? Pay everything, right? GST, ERP, COE, PA. I didn't say, Okay, anyway. Hey, you're videoing this, Okay, never mind. Now, but imagine if you just save 10% of your income. Is that possible? What's 10% of 36,000? Okay. 3,006. So imagine every year you save 3,006 and you just buy the index ETF and close your eyes. Go up and down, you don't. Hold for the long term. And every year just 3,006, 3,006, 3,006. Compounded at 12%, 12%, 12%. Compounded, right? What do you get after 30 years? Are you ready? Ready? Don't scream, Ding! 973,000, which is almost $1 million. Which means if you just save 10% of your income, buy the bloody index, hold for the long term, you get back 100% of what you earned. Hey, you don't look excited, I know some of you are thinking, I don't have 30 years left, Okay. She told me this 30 years ago, okay. Now, question. Am I saying that you can only get 12% return? No, I'm saying 12% is what? No, 12% is the minimum you should ever accept. Because 12% is called buy and hold and close your eyes and don't need to use brain. But if you're willing to use your brain and to actively invest, you should get a lot more than 12%. But my point is 12% is the minimum you should ever accept as an equity investor over time. Get the point? Okay. So question, can you make more? Can you make 15 to 20% returns from the index in the short term? That means not 30 years, but 3 months. Not 30 years, but 3 years. Is that possible? Yes. But to do that, you can't buy and hold. You have to do what we call trend following. Everyone say trend following. Trend following means you only buy when the market is on a what? Uptrend. And you must know how to get out when the market goes on a what? Downtrend. So here's an example. This is the STI from 07 to 2012. 5 years. Now, this was one of the worst 5-year periods in Singapore index history. Why? Because of the what? US financial crisis. The STI dropped 62%. I know, I wrote a book on it. Okay. Now, imagine if you bought the STI here back in 07 and you close your eyes and you go up and down, you don't care, and then you open your eyes after 5 years. What happened? How much you make? 0 after 5 years, yes or no? So does buy and hold work? Does buy and hold work? Yes, only for the long term. Buy and hold only works if you're willing to hold for at least 15 years. Then it works. Anything less than 15 years, you cannot buy and hold one. Because the market is so bloody volatile, you buy and hold and you open your eyes, you can end up negative or break even after 5 years. You get the point? So to make money in the short term, you can't buy and hold. You have to do trend following. You see, if you look at stock prices, every day, it jumps up and down like a yo-yo. You got no idea where it's going to go tomorrow, right? But if you read stock charts, you notice that market move in periods, or say periods. Markets move in periods of optimism and periods of what? Pessimism. When a market is in a period of optimism, it is called an uptrend. Now, on an uptrend, do the prices still drop? Of course they drop. But they go up, they drop, they go higher, they drop, they go. So although it drops, it keeps going what? Higher. When a market is on a downtrend, it's called market is pessimistic or bear. So markets may still go up, but it goes up, it goes even lower. Goes up, goes even lower. Understand what I'm saying? So the most important rule to learn is this. Only buy when the market is on a what? Uptrend. Can you repeat? Only buy when the market is on a what? Uptrend. When the market is on a downtrend, never ever buy a stock or the index. Because you don't know how low the burger can go. And something that seems very cheap will become even what? Cheaper. And you don't know how long it's going to last there. Make sense? Always wait for a reversal. So in other words, you only buy on the uptrend. So let's say you buy here, right? Buy here. Go out, make money, right? You're making money, riding the trend. The moment the trend reverses, what must you do? Get out, sell, and before the horrible crash. So everyone die except you. Then once you wait for the market to bottom, once bottom, reverse, new uptrend, what you do? Buy back on the uptrend, ride the burger all the way up, ride the uptrend, and then once the burger on the reverse, get out before the crash. So everyone die except you. So if you just buy here, sell there, buy here, sell there, would you make a lot more money? Yes or no? Yes or no? So why doesn't everyone do that? Because most people have not been trained to read trends. They got no idea what's the trend. They got no idea when the trend change. Yes or no? Question, how many of you have this experience? Let me show you this. How many of you have invested in stocks before? Okay. How many of you have this experience? Okay? You see your favorite stock is up there. And then it starts to drop. You say, wow, now very cheap, really undervalued. Someone analysts recommend buy. Wow. And then it starts to go up. Now it's going up, recovering, buy. See, alamak. They say, it cannot go lower lah. It's really so low. It's ridiculous. Below the NAV, cannot go lower already. And then burger, buy, see again. Cannot go lower. It's really so low already. See, pa. But then we go there, what happened? All your money gone. Then you got so frustrated. Every time you buy, it go what? Lower and lower. Until Indian, you want to say, mai seng liao. Don't want to see anymore. And the moment you say mai seng liao, don't see anymore, then the burger go, oh. Have you experienced this before? Why? Because people, they buy on the downtrend. They don't realize that all these are called false breakouts. Or we call them rallies on the downtrend. You don't touch here lah, walao. You only buy here when the market shifts, when the trend actually changes. Now the question is there a way to tell? Is there a way to tell the false breakouts from the real change in trend? Who says there's a way to tell? You came to the right place. Who says there's no way to tell? You can leave now. Okay. Of course there's a way to tell. If there's no way to tell, how do you think I make money? How do you think professionals make money? By reading trends. Okay? How many of you would like to learn how to read a trend change? How do you think that if you know exactly when the trend changes, you can make a lot of money and save a lot of money? Yes? So should I teach you? Yes. For free? Yes. Okay. I tell you, today I'm very generous. Okay? Now, I use a lot of strategies, which takes total of at least 46 hours to teach in my course, but I'm going to teach you my simplest technique, which will just take 5 minutes, right? And I call it my kindergarten technique. It is so simple, but it will already teach you when to get out and when to get back in to a trend change. Okay? So this is how it works. Now, let's imagine this is the stock price. It's going down, downtrend, right? You want to know when it what? Reverses. So one way to tell, one technique, is using a moving average crossover technique. Okay, how many of you know what's a moving average? Okay, cool, you guys know that. A moving average is a mathematical calculation that's done for you automatically using what? The charting software, right? Whatever software you use now. Okay? So, I use two moving averages, the 50 and the 150-day moving average. Here's how it works. When the market is on a downtrend, the 150-day moving average, which is the green line, is always above the 50-day moving average. And both of them are sloping down. How to remember? Very simple. Imagine this is a 150 kg man, fat man. 50 kg man, skinny man. Fat man sit on skinny man, what happened? Die. Very easy to remember, right? So just remember this. When the 150 is above the 50, never ever buy. It is suicidal to buy. Because it means it's on a down trend. And cheap will become what? Cheaper. By the way, both must slope down. The slope is very important. If they don't slope down, it's not counted. Now, how do you know when the trend changes? What must happen? The slope must change first. The 50 must flat and slope up, and it must cross above the 150. So now the 50-day moving average is above the 150. The blue is on top of the green. How to remember? Fat man below, skinny man on top. Fat man carry, skinny man go up. Simple? Are you with me now? Okay. Now, the opposite is true, right? So let's imagine. Okay. Where's my black pen? Okay. So this is an uptrend, and you are already invested. How do you know when to get out? You want to get out when the what? Trend changes. You want to get out here. You don't want to get out prematurely, correct? Man? Okay. Now on an uptrend, which is on top? 50 or 150? 50 is on top. Good. So the blue, 50 DMA, moving average, is above the green, 150. And to confirm the uptrend, both must be what? Sloping up. The slope is very important. Okay? Downtrend is signaled when the blue flat or reverse down and crosses below the 150. So now the fat man is on top, skinny man below. And both must slope down to confirm the downtrend. If one slope up, it's not confirmed. Now, once you know this, using whatever charting software, like Share Investor, Chartnext, whatever you're using, doesn't matter, right? Put it into there, boom! Then can you see your 50, 150? Must be using daily candles, by the way. Now, is it a lot clearer when the trend changes? Okay, now you can see very clearly, right? So let's take a look. So, can you see 50 cross 150? 50 cross above 150, uptrend signal buy. So you buy here, you ride the burger, go all the way up, make money, make money, make money, right? And then it dropped. Do you sell? No, why? Because the blue is still on top of the green. It's still an uptrend, just a dip, right? So keep buying more. Buy more on the dip. Then goes up, buy more on the dip, buy more on the dip. And then it drops. Oh, don't panic, blue haven't crossed green yet. Wait for blue to cross green. Once it cross confirm, can you see here? You get out here before the crash. If you knew this, the US subprime mortgage crisis would not have affected you very much. Yes or no? And that's how I save a lot of my students. I say, "Zao! Blue cross green already." So you get out here before the horrible death. And now that you know this, right, would you have bought any time here? No, green on top of blue, never buy. Wait for the blue to cross the what? Green, then you buy somewhere here. That's the uptrend signal, buy here, ride the burger all the way up, right. Blue cross green, do you sell here? Do you sell? No, why? Because the green is still sloping up. Remember? Must both flat or slope down to confirm the downtrend. So keep holding, keep holding. Now blue cross green, but blue slope down. Green, can you see both sloping down there? Okay, so you get out at this candle. Get out before the next crash. If you just simply use this, you would have what? Bought here, got out here, 40% return. Within 1 year. No? Get back in here, get out there, 39% return in another 1 year. How much you make in total? You make 79% what? Return. When everyone else made 0. And some even lost money. And this works on any chart. Okay, let me show you the Dow Jones. Where's the Dow? So Dow Jones, 06 to 2011. Again, worst 5-year period. Why? US crisis, 55% fall. Now, if you bought here, open your eyes after 5 years, how much you make? 0. But now you know my kindergarten method, right? The 50-150, right? Teach you in 5 minutes, right? Boom. Where's that there? Can you see 50 cross 150? Hello? Yes, buy there. Go all the way up, make money. Blue cross green, can you see that? Get out on this candle. And you make how much? 22% in 1 year. Not bad. Get out here before the horrible death. And all this is to trap all the amateurs, or kill them, all die. And 50 cross 150, buy back at this candle. Right? Ride it all the way. Blue cross green here. Can you see blue cross green here? Get out. Make 31%. Blue cross green back. Buy here again. Ride the burger all the way up. 19%. By the way, now the Dow Jones is ready at what? 14,000 here already. If you keep holding, it's really another, what? 30% return. 25 lah. Understand? So question, is this technique powerful? Right? Hello? If you think this is powerful, right, this is nothing, no. This is my kindergarten technique, no. I teach this in like 5 minutes. I teach this to kids, right? But in reality, I don't do this anymore. This is too boring for me. Okay. In reality, I use 5 moving averages, okay? Plus a lot of other indicators. Why? Then I get in much earlier than anyone else. I get out much earlier than anyone else. And once all my stars align, I know when the trend changes, okay? And when you learn all this stuff, it will blow your mind. You realize that now you control the market, not the market control you. You understand what I'm saying? And when people lose money, you make money. That's the key to it. Question, when a market is on a downtrend like this, right, what do you do? What do you do? Sell everything you have and short the market. So I teach people how to short the market in my program. So as the market is crashing, you are also making money. You got to make money in any market. Up, down, all must make money. If not, you're wasting your time. You get the point? All right? Okay, so what have you learned so far? Show you this chart. 72%. Okay, so for me, I use 5 moving averages, plus I use other things like force index lah, I use the stochastics lah, I use the parabolics lah, and I combine it in a certain way so I get a lot of accuracy, right? So what have you learned? The first thing you learn is what? You can make 10 to 13% returns by buying and holding for the long term, which is more than 15 years. That's called the buy and hold method. Second way, you can make 15 to 20% returns or more in the short term, in just a few months or few years, using what? Trend following. And I just taught you the what? Kindergarten technique, right? Okay. But if you want to make big money, then you cannot just buy the index. You must learn how to select what? Individual stocks that will outperform the index. Like I say, personally, for me, I don't buy the index anymore. I just buy for my mom. Okay? For myself, I go straight to stocks because it's a waste of time in terms of returns. All right? So if you want to make huge returns, right, 30%, 100%, 400% return, how do you pick winning stocks? Here are a few of the stocks I picked. Okay, so Goodpack is one of them at the time. And Goodpack, as you can see, went from $1 all the way to what? 220. Now you may say, but Adam, it was at 60 cents, or why you only buy $1? You can never catch the bottom. True? By the time the 50 cross 150 is already up by a certain amount. So we can never catch the bottom, we can never get out right at the top, but we get out somewhere there. You get the point? Is that enough for you? Okay. And if you just do that, that's a what? That's 120% return in just 11 months. Does that outperform the index when you buy the right stock? American Express was another one of my big holdings back in the crisis days. It's in my book, if you read it. I bought this. $13 all the way to $43. Today, American Express is already at, what? Close to $60 already. And there's a 300% return in 11 months. Outperform the Dow. Okay? General Electric from $9 to 18. Now it's about $24. Right? Still going up. Right? It's 2% return. And my favorite stock of all time, the stock that made me the most money, but I sold already, because the guy died. And the stock's on a downtrend now. Apple. Apple went from $100 to where? 596. And I sold somewhere there. And then after I sold at 596, the burger went to 700. But luckily, from 700, boom, now crashed to 400. Okay. So you must know when to get out and when to get back in. So right now, example, Apple is very cheap, but I dare not buy. Because it's on a downtrend. Downtrend I never touch. You don't know how low it can go. Must wait for reversal pattern. So I'll teach you how to read reversal patterns, okay? Now, question, can all stocks outperform the market like this? Of course not. How many percent of stocks can outperform the market? How many percent? Less than 5%. 95% of stocks that you buy will go where? Sideways. Or just go up a bit. Huh? Or drop and never come back. So how do you identify these winning stocks? How do you say that all these winning stocks have got certain things in common, certain characters? Oi. Who says they've got nothing in common? They went up purely by luck. Because the CEO went to Baijia. No, right? They've got certain things in common. Now, is that good or bad? Good. Because if you know what they have in common, before you buy a company stock, they must meet all the what? Criteria. I've been investing since I was 18 years old. Right now, I'm 39, so it's 21 years. I specialize mostly in the US market. Name me almost any US stock, I can tell you the pattern. Singapore as well, Hong Kong, a bit of Malaysia. And I have found that stocks that outperform the market, they all meet up to 10 criteria. How many criteria? 10 criteria. You want to learn the 10 criteria? Okay. So let me share with you a few. What is the first thing that all those stocks have in common? The first thing is this. Normally, before the stock chong, as in rise, normally insiders will be buying the stock aggressively. Who are insiders? Insiders are people working in the company, especially C-level. CEO, CFO, and what? Chairman. When you see all the directors buying at the same time, that is the first signal. Because they're taking their own money to buy their own company share. You think they're stupid? They're not stupid, no. They know that their company is worth what? More. At the same time, all the directors are selling, you want to buy? Avoid that company. Understand what I'm saying? Directors are not stupid. How many of you know you can get all this information? Okay, great. How many of you didn't know? Now you know. Okay. Do you know that any insider who buy or sell a stock, they have to declare to the what? Stock exchange within, if I'm not wrong, 5 working days or 3 working days. So all this is published, but people don't know where to find. So I'll teach you where to find all this insider trading data. And I'll show you an example. This was 22nd May. You can see all these directors were all buying on the same day. Very rare to see this. And they all bought at $2.51. What stock is this? CapitaLand. Now, CapitaLand was at $4, and then it went on a downtrend. From $4, downtrend, all the way to about $2. It was a 1-year downtrend. And then suddenly, I was tracking the insider trades, right? On 22nd May, what happened? Then it was a downtrend, all the way downtrend, right? On 22nd May, on this particular candle, right, all the insiders were buying aggressive at 250, right? What happened within 1 week? Pam! The burger reversed 56%. Is this coincidence? I don't think so. This has also saved me a lot. Have you heard of Faro China? Faro China was a Chinese steel company listed in Singapore. At one time, analysts were rating, wow, strong buy, revenues climbing, profits climbing, right? I told my students, don't touch this one. And sure enough, they found out that what? All the revenues and profits were what? If I'm not wrong, it was fictitious, right? Right? It was fake, and the whole thing collapsed, people lost everything. And they say, so unfair, how we know? Actually, it's very easy to tell. You know how to tell? First thing was that their accounts receivables was growing at triple their net profit growth. When you see a company, the accounts receivable is growing faster than their revenue and net profit, right? Something is wrong, Either the burger cannot collect money, or it's all fake. That's the first signal. Red flag. Second signal, the chairman, after the company IPO, every 3 months, the burger dump the shares. Walao, you see this confirm you short on it. You get what I'm saying? So if you don't know all these things, you can't win the market. The market will keep taking money from you. But once you learn this, then you start taking money back from the what? Market, because you know how to play the game. Okay, criteria number 1. Are we clear? Okay, criteria number 2. By the way, all the criteria must meet, not just one. Like recently, you know Nobel Group? Nobel Group dropped after their earnings was released, dropped by I think like 30%. And then the chairman, what's his name? Richard Ellis, is it? I can't remember his name. He bought $10 million worth of shares, which is normally a good sign. But the stock still dropped another 30%. So you cannot only look at criteria number 1. All the 10 must match one. Okay? Criteria number 2 is you only buy when the stock price is selling below the intrinsic value of the stock. Okay, everyone say intrinsic value. What is the meaning of intrinsic value? Not price to book. Okay, let me give you an example. You see, American Express was selling at $13, right? Then from 13, it can go to 43. Are you telling me that the company tripled in profits? No, it's the same company. What? So why? Because the intrinsic value of the stock is $45. Now, what does intrinsic value mean? Intrinsic value means what the stock is really worth, based on what? Okay, first, based on their net tangible assets. You add up all their cash in the bank and the current assets minus all their what? Debt. That's the book value. Plus operational cash flow. How much cash are they earning on an annual basis discounted? That's called intrinsic value. Right? And I'll teach you how to calculate this in the program. Now, you may say, Adam, if the stock is worth $45, right? Like what you say? Then why is it selling at $13? Then why is it selling at $13? If it's worth 45. Why? Because you must understand that the stock market in the short term is what? Irrational. It's totally illogical. The stock market in the short term, you look at the market every day, go up and down like yo-yo. Does it mean the company changed that day? It's the same company, what? Making the same profit, what? But what makes the price go up and down? Demand and supply, you and me. When everyone is buying, okay, let's say all of you now got $1 million. On Monday, all of you chong and buy CapitaLand at the same time. What happens to the share price? Pam, fly. If all of you dump, the thing will crash. But it's the same company, right? So it's demand and supply that drives a stock, You know what I'm saying? What drives demand and supply? What makes people buy and sell? We like to think it's logic. It is not logic. It is sentiment. It's purely emotions. When people are fearful, they what? Sell, they dump. When they are optimistic, they buy. And what drives emotions? News. Correct. Like last year, they announced the news. Greece will default. The euro will break out. Wow, panic, pow, the market just crashed. Right? And then a few months later, they announced, oh no, we're going to save the euro. Pow, but go up again. Market is mad, but good. That's how we make money. So the market is crazy, and they dump, and the burger what? Fall. Sometimes it goes below the what? Intrinsic value, creating a mispricing arbitrage opportunity. So that's when you buy under what? Value, and then eventually when the crisis is over and it revalues, you make a lot of money. Understand what I'm saying? Okay. So let me give you an example. Hey, by the way, so the point is this. The most important thing is you must calculate what? Intrinsic value. Okay? Now, normally you need to have a finance degree or a CFA to learn how to calculate this stuff. That's what I learned back in NUS. So how do I teach amateurs? How do I teach housewives? How do I teach retirees? How do I teach air stewardess how to invest? I created an intrinsic value calculator. So all the formulas are what? Pre-programmed. So no need to use brain. No need to use brain, right? Just put in the numbers from the annual report, it generates it for you. You want to see how it works? Okay, let me show you. Okay? Hey, by the way, how many of you have heard of Raffles Education? I hope you didn't buy it. Raffles at one time was highly rated strong by analysts. Because they said education, good industry. Some more China, the burger, people punted it all the way to where? 156. At the time, I remember the PE ratio was 60. It's crazy. Anyway, when the financial crisis hit, people what? Panic and they dump. They dump everything, right? And from 150, they pump all the way to what? 6 cents. So some of my friends call me up. They say, Adam, Raffles Education was at 150. It's a 150 stock. Now it's at 60 cents. It's like half price. It is so cheap. If I buy now and it goes back, I can make a lot of money. At 60 cents, is it cheap or not? Yes or no? You can't tell from the chart alone. The chart only tells you the emotions of the market. It doesn't tell you what it should be logically worth. You have to take out the annual report, take out the figures and put into the calculator. So I'm going to show you the intrinsic value calculator. Sorry, where did I put it? Let's see. Raffles, right? Okay. So this is the intrinsic value calculator, and if you just key in, right, the company's operational cash flow, the debt of the company, the cash and equivalents, right? It was back in 2009, right? What's the intrinsic value after less debt plus cash? 31 cents, no. This stock is worth 31 cents in selling what? 6 cents, it is still overpriced, right? And sure enough, I told my friends, I said, don't touch this stock until it goes at least 25 cents, then can talk about it. Then at least undervalue. And sure enough, if you bought it at 60 cents, it went to what? 27 cents and all the way down to 19 cents. And this is logic. Why? That's what it's worth. On the other hand, look at Goodpack. Goodpack was at 220. Again, when market panic, market dump everything, everything comes down. Right? And went to 60 cents. Same price as Raffles. This one cheap or expensive? Again, cannot tell. Must calculate the what? Intrinsic value, right? So if you put in the intrinsic value, where is that? I put it here. Right? You put in the operational cash flow, the total debt of the company, the growth rate, and the intrinsic value is what? 241. And it's selling at 60 cents. What is that called? That's called the Great Singapore Sale. Buy! And sure enough, when the market came to its senses, boom, the market corrected back to 220. That's how you make what? Money. But let me ask you this. How many Singaporeans, when they buy a stock, they know what's the intrinsic value? They don't know. That's called gambling. If you gamble, you make money out of luck, later lose everything back. But if you know what's the intrinsic value, it's not gambling, it is called investing. How many people are true investors? Very few. So I don't teach people to be punters, speculators. You want that, go to other people. I teach you how to be investors. Are we okay so far? Okay, so number one, insiders are buying the stock. Number two, it must be under value. But number three, the third point, up. Sorry, I'll show you something first. How many of you read analyst reports? You can read, but don't follow blindly. By the way, the reason I show Kim Eng is because they are my broker. Okay? And they send me reports every day, right? So like, they sent me this report on 4th of April 2011, and they recommended buy CWT at 125, their target price 190. Now, if you are a person who's not trained in investing, you read the report, oh, this analyst very smart, buy. But if you use the intrinsic what? Value calculator and actually put in the figures from the report, right? You know what's the intrinsic value or not? Huh? How much? 93 cents, they sell it. And sure enough, if you bought at 125, bye-bye. Drop by how much? 30%. Then I show you another one. Then he sent me this one. Nobel Group. 8 November 2011. Recommended buy at 156. Target price 205. Never listen blindly. Do your own research. Now, if you look at the Nobel chart, they recommended to buy at 156 here. Can you see that? Now, can you see the green is on top of the blue? Hello? Are you mad when you buy the green on top of the blue? Downtrend. Sure enough, the moment you buy, palm on the way. And continue the downtrend on the way. So 2 mistakes. Number 1, you never buy on a downtrend. Number 2, you never buy before earnings are released. In fact, I always sell my stock before earnings is released. Because you don't know what's going to happen. They announce back and then, see. You know what I'm saying? Okay? So, number 1, insiders are buying the stock. Number 2, buying undervalued. Number 3, don't read reports blindly. Now, next thing is this. The third point is one of the most important points. How many of you have heard of this thing called value investing? I used to be a big proponent of value investing last time, until I lost all my money. Value investing only works if you're prepared to hold for at least 10, 15 years. And value investing is very dangerous. Why? Because value investors only look at fundamentals. They don't look at technicals. They only look at the logic. They don't look at the emotions of the market. So whatever they buy, they think is cheap, become even cheaper. You know what I'm saying? So let me give you an example. That's why the third criteria is this. Even if the stock is cheap, you cannot buy unless it is on a what? Uptrend. The trend must always be followed strictly. Okay? And the other 7 criteria, I'll teach all of you in detail in my training. Now, how long do you think it takes to teach all this? Just these 10 steps. These 10 steps alone, by itself, takes me about 27 hours to teach. Why? Because teaching the theory is very easy, but how do you apply it to Singapore stocks, US stocks, Hong Kong stocks? In my training, it is very practical. You bring your laptop down, right, in my program. You got no laptop, you must beg, borrow, or buy. Don't steal. And then in my program, I will give you stocks. Say you look at SGX, you look at UOB, you look at Google, you look at Apple. And then within half an hour, you need to go through all the tests and present to me whether you can buy or sell. And that's how I train people. I train stock analysts, I train remisiers, I also train housewives. I train all kinds of people on how to do all this research. So it's really hands-on research. Okay? So let me give you an example. Now, this is Goodpack again. Goodpack is a Singapore company, and honestly, it's a very good company. Solid revenue, solid profit growth, conservative debt. Great company. If you calculate the intrinsic value, it's about what? 220. And you can see it was selling at the intrinsic value. But during the financial crisis, when people panic or out of fear, they dump and what happened? From 220, right, pump, it dropped to what? 160. Is this undervalued, yes or no? Yes. So a pure fundamentalist value investor, will he buy? Yes, cheap what? But they don't know that cheap downtrend become even cheaper to 60 cents. But you know what they say? Never mind, it's a good company. I hope for the long term. When my students tell me I hope for a long term, I slap their face. I say, don't give me that rubbish. Because you don't know how low it can go. And if it's a good company, will it come back one day? Yes, it will. But by the time the burger come back to 160, how long it take? 2 years to break back. Your money stuck there for what? Don't make sense, what? So you must always put in what? At least put in the 5150, the kindergarten technique I taught you, right? So now you know the moment the what? The blue cross, the what? Green, although it's cheap, cannot buy because cheap will become even cheaper. Wait for the reversal blue cross green, all right? Only buy at $1 and then ride the burger all the way. Can you see blue cross green? And then you must know how to sell before the next crash. And how much you make if you buy at 1 and sell 190? How much you make? 90% in just 1 year, when everyone else made nothing. Does this make sense? Okay, still got time. Okay, could be a time. Okay, question. Is now a good time to invest in the stock market? Vis-a-vis property, vis-a-vis gold, vis-a-vis commodities. Who say yes? Who say no? Now what are you coming for? Now, to answer the question, first you must ask yourself, are stocks cheap right now? Who say they're cheap? Who say they're not cheap? Now, you cannot just guess. In investing, you cannot guess. So you need to what? Look at what? Hard numbers. So let me teach you how to tell whether it's cheap or expensive, okay? One way to tell is this. You see, why do this thing's dropping? Okay. See, markets move in cycles. Let me show you. Markets move in what? Cycles. Okay? And this is the center of the cycle. This is the bottom of the cycle, the top of the cycle. When do you want to buy stocks? At the bottom of the cycle. You never want to buy near the top, like back in 98 and 87, right? Okay. Now, how do you know where you are? One way to tell, I teach you another kindergarten technique, is using the index PE ratio. You all know what's PE, right? Price to earnings. Now, normally PE for stocks is very misleading. So I don't ever use it for stocks, but I use it only for index. P stands for what? Price divided by earnings. And you calculate a ratio. So what's the index PE? It means you add up all the stock price of the stocks in the index, divide by all the earnings per share to get the index PE. Understand? Okay. When the market is at the top of the cycle, that means prices are very what? High relative to its earnings, right? So P is very high. When the market after crash, jialat already, right? Prices are very what? Low relative to earnings. So P is very what? Low. So whether the P is high or low will tell you where you are in the cycle. So what is high, what is low, right? So let's take a look at some historical figures. Actually, I shouldn't show you this first. No, I don't show you first. Okay, see whether you can guess. Okay? What do you think is the lowest PE ever recorded in history? That means after the subprime crash, after dot-com crash, right, the lowest PE ever recorded is what? Singapore is 6, correct. US? 5. The lowest PE recorded is 5. That's the bottom of the crash. When I wrote this book, right, Profit from the Panic, the PE at the time was 5.7. That's why I told everyone to start buying the market, because it was the confirmed bottom already. That's how I tell them. Okay? Now, when the market is at the top of the cycle, what's the PE? 25 on average. Although during the dot-com bubble, it did go up to 46. That was the super bubble. Let's burst. And the center of the market, the P is what? 15. All right, so now I'll show you the chart. Take a look. Okay, now this is the P ratio of the US market for the last 136 years, since 1871. Enough data for you? Okay. And you can see that after all the market crash, what's the lowest PE? Can you see that? The lowest PE is what? 5. And the market top crash, all the market top is what? 25. Except dot-com bubble, it hit 45. That was a bit crazy. And the center of the cycle is what? 15. So every time the PE of the index is above 15, it is above fair value. Below 15 is below fair value. 25 going to crash. How about Singapore? All right, Singapore, you can see for the last 14 years, during the dot-com crash and the US crash, what was the lowest? About 6 point something. You see? The top is what? 25. And the center is what? 15. So question, where are we now? Where are we now in the cycle? Are we near the top or the bottom? Okay, so to find out, where do we go? We can go to this place called what? We go to this place called Bloomberg.com. Have you heard of Bloomberg? This is my favorite website. After you attend my course, you go to this website more than Facebook. Okay, now let me show you. Can you see? Let me make it bigger. Can you see these are all the index? Can you see the P ratio here? Can you see? Can you see that? Okay. So what is the PE ratio of, which one can you see first? Singapore, okay. Can you see Straits Times Index here? The PE ratio of the STI is 13.18. It's still undervalued. And the top is 25, which means can the STI double from here? Hello? It can still double from here. Okay, Malaysia is 15, a bit more expensive. Shanghai is 12, damn cheap. China is damn cheap. Hong Kong also is damn cheap. Hong Kong, the P is only 10. Okay? The US market, if you look at the Dow Jones, is about 14.4, which is higher, but it's still undervalued. Which means if you look at global markets, looking at this trend cycle chart, right? Where's Singapore? Singapore is at 13, right? Here. STI is here. Hong Kong is at 10. Shanghai is at 12. US is at 14.4. The global markets are still what? Undervalued. So are you very lucky to learn all these things now? You're learning at a time where the market is not near the top yet. Of course, if you attended my program 2 years ago, you're even luckier. Those of you who came on program 2-3 years ago, right, the market was here. P was 5 or 6. But now, it's gone up obviously, but it's still nowhere near the what? Top. But if you procrastinate and say, you know, I'll learn this next year, learn this next year, and you procrastinate, guess what? The longer you wait, what happens? The market will travel up the cycle, and you got to wait for the next crash to get in again. Get the point? So it's all about timing now. Right? It's all about timing. So to answer the question, are stocks still cheap? Yes. But remember, cheap can become cheaper. So second question is what? Are stocks on a what? How about downtrend? Let's take a look. This is the US market. As of 2011 December, right? Can you see the blue cross the green? That was the signal already. And that's when you go long and you bought at You bought at how many points? You bought at 1,270 points, right? and the burger all the way to 1,500. Can you see that? Same thing. Singapore is the same thing. The 50 cross the 150, you're riding uptrend. So I always say as an investor, right? People ask me, Adam, where is the market going to be next year? My answer is, how the hell would I know? No one can predict the market. So I don't predict the market. I just follow the market. Market uptrend, I buy. Market downtrend, I sell and short. Very simple. You get a point? So you must know how to read where the market is now, not to predict where, because no one can predict the market. Okay? Question. If you follow all these rules, that means you buy only on what? Uptrend. You buy when it's undervalued. You buy when revenues are growing. If you do this consistently, will you always make money on every investment? Yes or no? Yes or no? Of course not. No technique in the world makes you money all the time. It does not exist. Yes, so there's no holy grail one. And although my technique, I would say, is one of the best or the best right now, it doesn't make money all the time. But what is important is this: I make a lot more than I lose. Because as long as you make more than you lose, and when you're wrong, you learn to cut your loss very fast, are you still profitable? Yes, and that's the key to investing. It's not being right all the time, it's being right more than you are wrong and cutting loss when you're wrong. That's the key to investing. All right? And let me show you this. This is my portfolio. It is live, and it's on this website called wealthacademyinvestor.com. But you need to log in with a password. So those of you, if you finish my training, you get full access to my portfolio. So everything I buy and sell is updated within 24 hours. This is live. All right, and you can take a look right now. I'll show you. This is a live portfolio. These are my current positions. Right, these are my US stocks. Okay, and these are my Singapore stocks right now. All right, and these are my closed positions. All right, so you can see that, I mean, not every trade is profitable. All right, along the way, you make what? You make losses, but you must cut loss very fast. So for me, right, most of the time, I will never lose more than 6%. I will always cut before that. Cut. Right? And it's about being right more than you're what? Wrong. And sometimes you get a really good 200%. Okay? Once in a while. Right? And that's my Singapore stocks. Right, I hate China Mincho, damn it. Okay, BreadTalk made a very good run. Right? I went in and out BreadTalk twice. If you look at the total, I made about, what, 90% on BreadTalk, right? China Mincho, damn sway. I keep losing on that one. Right? Okay, and if you look at most of my trades, how long do I hold? You can see I bought in March, I sell in April, just hold for 1 month only. This one bought in March, hold for April, less than a month. This one was quite a long one, which is quite rare, but it's 40% return. And if you look at most of it, I hold for what? I hold for about 2 to 3 months. So I'm averaging, on average, if you take a look, I'm averaging about 15% return every 3 months. Now, if you do that compounded, how much is that a year? That's more than 60%. Good, huh? Okay, lah. But if you use CFDs and you leverage up, you can make a lot more, right? So part of my portfolio is leverage using CFDs. Now, I'll just show you some of the emails I got over the years of teaching this program. This guy really came in at the right time, right? He got my book, learned my program back in 09, right? When I launched this book, Profit from the Panic, made $300,000 in 11 months, 75% return. But that was when the market was bottom and it was reversing. Hoxing. Then this guy, his name is, what's his name again? Christoph. Christoph is living in Thailand, Bangkok. He's a property developer. And he flew all the way to Singapore to attend my program. And he said, Adam, over the years, I made my money in property, lost everything in stocks. Because he's a property guy. He knows nothing about stocks. But he said, I have to learn about stocks now because I think property is a bit too pricey and I have to diversify. So he recently sold most of his property. He went back into the stock market. And once he learned all that stuff, he said, I know what I'm doing now. And he made 30% return in just 4 months. If he can do it consistently, that's more than 60% a year. But that, I don't know whether he can. Yeah? Wait for his email 6 months from now. All right? This guy, his name is Yash Gupta. And Yash attended my program last year. He was working as a director in A-Star Aerospace for quite a number of years, making a very good income. And he was forced to retire last year because he hit the mandatory retirement age. And he came to me and he said, Adam, I have to learn this stuff because all my years of saving my money went to 2 things. Number one, well, went to 3 things. Number one, my kids' education. His 2 daughters have graduated from Ivy League school. If I'm not wrong, one of them is Harvard. And he sponsored all of their education. The second thing that ate up his money is his medical. He got brain cancer and a stroke at the same time. So he walks with a limp. So that took out a big chunk. The other third thing was all his investments. He did not know how to invest, right? He lost a lot of money based on listening to advice. And he had very little left. And he said, Adam, I'm forced to retire now. I've got no more job. I can't get another job now at my age. And he said, if I live to maybe 75, 80, I can still tahan if nothing happens. But he says, if the cancer comes back, I'm dead. Because no insurance company would insure me anymore. And that's what drove him to come to learn this stuff. And after that, he went back, he did pretty well, pretty decently, sent me an email, made 16 grand within 6 months. Although the return is not very high, but I mean, good for a retiree, right? So what I teach people is how to become your own hedge fund manager. Where part of your money, you must learn to invest in what? Index what? ETFs. Part of the money you invest in what? The right kind of winning stocks. Part of the money you invest in what? Real estate. If not, you invest through REITs, okay? I teach an entire section on REITs alone. And REITs, there's a different set of rules. Stocks, I told you 10 steps, right? REITs, 6 steps. And there's a 6-step process to selecting REITs. Like in Singapore, there's about what, 35 REITs? Personally, I only dare to buy about 8 of them. So I'll teach you how to select the kind of REITs to buy, yeah? How much do you need to get started? A lot of people think I need millions, thousands. It's not true. Okay? I work with people who have got very little money as well. I've got students who come, undergrads, and their parents sponsor them to come to my course. And after the course, right, they say, Adam, we really got no money because you're a student. You know what they do? They paper trade. You know what's paper trade? They open an account with the broker and paper trade with fake money to practice. So they say, by the time I get my job after 2 years, I would have all the what? 2 years of what? Trading experience. And they start to really do well. Yeah? This guy, his name is Thomas. And Thomas, he told me not to mention which exact organization because it's a bit sensitive, but it's a civil servant. And it's not a very high pay, but he's been saving up. And when he came about 2 years ago to the program, he had 10 grand in savings. He said, what can I do with it? And he sent me this email after 2 years. He says, hi Adam, the investing techniques I learned helped me grow my initial investment of 10,000 to around 18,000 in about 1.5 years' time. However, besides monetary gains, WA taught me much, much more, which spurred me to commit myself to achieve more goals in life. So you may think that 10K is no big deal. Yeah, it's small money, but the point is the return, yes or no? And what's that return? 80% in 1.5 years. That's not too bad. That's 50% return a year. No? Okay? This other guy, he's a Malaysian trainer. He trains remisiers, he trains fund managers. And he's a CFA trainer. You know CFA, right? Chartered Financial Analyst. He's a CFA trainer, right? He attended my program back in 2012. He said, first and foremost, I have to admit that the session provided very good insight into the methods of stock selection and personally applied in my real-life stock investments. Guess what? The return of those stocks, he basically bought all these now, right? BAT, British American Tobacco, 44% return, Public Bank, 46% return, and whatever, 100%, 35% return. He says, I can go on and on. Your simple stock selection techniques were indeed helpful. Honestly, it was way better than many of the trained fund managers out there. For your information, I've been doing a lot of training to brokers remisers in Malaysia just last year alone. What was indeed said is that most of these brokers have lost their fortune since the crash of 98 and 2001. Many of them, despite being in the stock market for more than 10 to 15 years, do not even possess simple knowledge on proper stock selection. It is scary. I got a lot of brokers coming to me right now, learning all this stuff. Okay? How do you feel in the last 1.5 hours? Your financial IQ went up by a little bit. I did my job. Did my job, great. But what you learned today is what? Less than 1%? Less than 1% of what you can learn. And when you learn with the 99%, you will be empowered to take control of your finances and not let the market control. You get a point? But I always say this, I can give you all the knowledge, all the skills. Is it good enough? No. Unless you have the right what? Mindset. If you don't have the right mindset to succeed, the best techniques will not help you. Is it possible that I give the same lecture? 2 people sit side by side. Okay? And one person after hears the talk says, wow, I want to learn this. And they go back and they take what? Action. They go and invest. They go and cut loss. They go and read the trend. And they make a lot of money. The second fellow says, oh, Adam, what you teach is so fantastic. It's great. I will do it tomorrow. And they go back. They don't do. In the end, 5 years later, still broke. Is that possible? Because it's all the mindset. Question is, do you have the mindset to succeed? Okay, I hope so. So in my training, I'm not only going to focus on the techniques per se. I'm going to invest a lot of time on the psychology of wealth creation. How do you think like a multi-millionaire? How do you create that wealth? And there are two things I like to share very quickly. The first thing has got to do with this thing called your beliefs. Guys, can we all say it together? All say beliefs. What are beliefs? Beliefs are what you think you can or cannot do. Beliefs are what you think is or is not possible for you. Now, there are so many of you in this room. Do all of you have the same beliefs? No. So, let me ask you this. How many of you believe that if you work very hard, with the right strategy, with the right mentor, how do you believe that you could make $1 million in, let's say, 5 years, for example? Show of hands. Okay, great, thank you. How many of you believe that no matter how hard you work, to make $1 million in 5 years is not very realistic, honestly? Okay, thank you for being honest. So notice, when I ask this question, different people raise their what? Hands. Because we got different what? Beliefs. So whose beliefs are right? Those who say can or those who say cannot? You're both right. Henry Ford said, whether you believe you think you can or whether you believe you think you can't, either way you're right, as you know. Because you will prove yourself right. For example, if today you have this belief, yes, Adam, I can make a 30% return every year on my investments if I'm willing to learn how to do it and to really be disciplined to follow my strategy. Yes, I can make $1 million in 5 years. Now, if you really believe that question, would you set a higher target for yourself? Yes or no? Every morning when you wake up, will you be more motivated to take new action? Yes or no? Will you start to do your research? Will you start to learn? Will you start to trade? Will you start to invest? Yes. And by taking action and giving your 100%, your all, in 5 years, will you become a millionaire? Yes or no? Yes or no? No lah. There's no guarantee in life. You may or may not become a millionaire in 5 years, right? But even if you don't, would you get a lot more results and a lot more success than what you're getting now? Yes. Guarantee. Why? Because you put in a lot more what? Effort. And when you put in a lot more effort, you tap a lot more of your potential. Sure, you bring out the best in yourself. You get the point? But if now you're sitting there listening to me, and you got all the what? Negative beliefs. Adam, yeah, you can do it. Your student can, but I cannot. You know why not? I'm too old. I'm too young. I'm not good with numbers. I cannot see stock chart. I cannot see the 50, 150. I got no capital. I don't like to take risks. I got no time. And you got all these limiting beliefs. Guess what? Then you don't even start. You don't even take the first step. And you keep staying in your what? Comfort zone, doing what you've always been doing. And if you keep doing what you've always been doing, 5 years from now, where will you be? Not same, worse. You know why worse? Inflation. So 5 years from now, will you be richer or poorer? Better or worse off? The answer is it depends on you. It depends on the choice you make today. Do you realize that? So the fact that you choose to come and educate yourself is already, at least you take the first step. But are you willing to take the next few steps? And the choice you make from today onwards will design your financial destiny. It is your choice. Your wealth is in your own hands right now. Okay, second thing. Are beliefs good enough? You can believe all you want. I believe, yeah. What's the point? No use unless you take what? Action. How many of you really want to be financially more successful, honestly? Right? All of you want, yes or no? Every Singaporean wants. But why isn't every Singaporean successful? Because they only have this thing called what? Intention. Everyone got intention. I want. But few people take action. The difference between people who are rich and people who are broke is people who are rich are people who take what? Action. They just do it. Like Nike. These people only think and talk and never do anything. So please take action if you want to create it. Okay? Now, sorry, let me take 5 more minutes. Alright? If you want to take action, alright? Let me skip this part. Alright? Okay, let me cover this part very quickly. Right? I find people face a lot of financial challenges. Like they say, I work very hard and find that there's little to show for it. My wealth is not growing. Or they say that, I feel I don't have enough to live the lifestyle I want. Or I constantly get worried and stressed over money. And then I wonder how come some people can make money so easily, Someone when they were younger, right, I did better than them in school, So if you feel this way, it's not because you're not intelligent. It's not because you're not hardworking, because I believe you are. But if you experience this right now, it's only for one reason. It's simply because of your what? Financial stress. It's how you're managing your money and your investments. And if you keep doing the same thing the same way, what will happen 5 years from now? You'll be getting the same result. The good news, anybody can and what? Deserve to be financially successful, regardless of your education level. I don't care whether you're O-levels or PhD. It doesn't really matter. I don't care your age. My oldest student so far in this program, guess how old? Not 80. 78. From Jakarta. And my youngest student in this program, right, Jakarta also, 13 years old. But most of them who come are in their 40s. Anyway, all it takes is the right financial mindset and the will to take what? Action. If you want to take action, I run this program, Wealth Academy, now for 9 years already. All right? And my program consists of 6 parts. First, a 4-day intensive wealth and investment camp, taught by me. Followed by booster sessions, home study materials, online video tutorials. So whatever I teach is video, and you can watch it online to revise. Because I know people need to see, people learn at different pace. Yeah? So some of you may have to go back and watch it a few more times and really master it. And then we have got quarterly money skills workshop, and you get to join my monthly Investors Inner Circle Club, where every month we meet to share the greatest investment ideas today. My entire program comes with a free lifetime reattendance, which means once you attend one batch, you can come for all future batches free of charge. But every batch is fully booked. In fact, my next batch in May, I've got less than 10 places left already. It's already almost full. So you got to book at least 2 months beforehand to get a receipt place. And if you do, you're sure to get a place. And people do come back to receipt to refresh. On day 1, which is a Thursday, 7 p.m., we start to a bit late. Okay, I talk a lot about the psychology of wealth. How do you develop the millionaire's mindset? How do you think differently from the rest of the people in Singapore? How do you inculcate the habits of self-made millionaires? You'll be learning a framework of how to set goals, how to motivate yourself consistently to reach the targets, how to turn setbacks into learning opportunities. And then you learn the basics of what? Cash flow management, asset allocation. On Friday, we cover the 8 steps to financial freedom, personal financial management, the psychology of successful investors, how to read and analyze stock charts, how to read the emotions of the markets using technicals, how to achieve 12 to 20% returns using index ETFs and trend following, how to accurately identify what? Up and down trends. So Friday, you must take leave. If you got no more leave, take MC. Nowadays, doctors are very lenient. Okay. Saturday is another full day. I'll be teaching how to identify the most profitable companies in Singapore, in US, in Hong Kong. Okay? And then we go to the 10 steps. Okay? How to calculate intrinsic value, how to follow the insiders, how to access stock purchase of the top fund managers, people like Soros and Buffett and John Paulson. How do you track their portfolios? Hands-on research and practice. How to set up a brokerage account and how to use the trading platform, how to use the charting software, how to place and execute orders, right? And then Sunday, right, you can learn how to find the best investment opportunities through what we call screening the market, stock screening, how to build a low-risk, high-return portfolio, how to short the market and profit from downtrends using CFDs and using inverse ETFs. And we also teach you how to create multiple income streams from home-based businesses. Plus, you get all these financial software, intrinsic value calculator, financial freedom calculator, financial tools. So all this is packaged for you. Right? It's the ultimate financial management program. Okay? Then we got 2 booster sessions where I'll teach you how to build passive income using REITs, how to achieve a 60 to 80% return. Yeah, I'm not kidding. 60 to 80% return on CFDs using leverage trading, margin trading, risk management and emotional management in investing. Okay? All right? And you get my books, my audio CDs and all that. Plus, you will come to my training center once a month for the rest of your life, or until I die. Every second Monday of the month, we've got our Investors Inner Circle meeting where we come and share our latest stocks that are on an uptrend, the latest stocks to invest in. Okay? And then we run also competitions to compete against each other for fun. Right? We give away a lot of prizes. Right? And we put them into GRCs, by the way. Share with you very quickly another few more things, right? This guy, his name is Ken Yung. He says, "Hi Adam, just wanted to drop you a short note to express my gratitude and thanks to your time and effort. Before attending your course, I invested based on friends' recommendation and on my own random analysis. I made a slight loss after holding my investment for more than 2 years. In January, I read your book and attended the Wealth Academy in April 2012. I just checked my year-to-date investment yesterday and I've recouped all the loss in 2011 and made additional 34% return on my entire portfolio, 10 times what I paid for the course." So guess how much he made? A lot. This one was sent by William and Sharon. Yeah? "Dear Adam, Happy New Year to you. We have benefited greatly after your attending your Wealth Academy seminar in January 2009. By now, we have recovered our losses of more than $50,000 and holding on to some good gains. To be able to recover such huge losses with gain is not possible if we just tikam." How many of you have lost money in the market before? Now's the time to make it back. Because if you lose money and never make it back, it is a real loss. But if you lose money and you make it back, you're merely a tuition fee, true or not? And it's time to make it back from all the people who took it from you. Okay? This was an email sent by a DBS Vickers Remisius to his customers. All right? Derek Koo. No relation to me, by the way. But I got a hold of this email. It says, "In the last 2 years, I had the opportunity to work with the graduates of Adam Koo's Wealth Academy program. Many of them knew nothing about the stock market or had lost a lot of money on their previous portfolio. I then witnessed how Adam's course on financial education changed the lives of people who learned and acted on his advice. They became more confident in the market and made good returns on their portfolios consistently." All right? My next intake coming up, 30th May to 2nd June. All right? I've got less than 10 places left. A few have been taken up already. If you want to find out more, please see us at the booth behind. Okay? My booth is right there, behind there. Okay? And let me just... Sorry, one moment. Okay. He's always shaking. Every time I invite Adam, he won't get off the stage. My God. Sorry. Okay. How many of you went to university or college? Okay. And how long do we study in university for? Right, 3 to 4 years, right? And how much we spend on a university education? Nowadays, it's at least 30,000 locally. Overseas, at least 200,000 years, you know? Is that a lot of money? Is that a lot of time? Why? Why do we do that? Simply to get that degree or that diploma. Our parents told us last time, education is important, yes or no? Study hard, get good results, get good paper qualifications, and you have a bright future. Is that true? We all kind of gone. Now, I'm not saying that this is useless. But how do you agree that this piece of paper is nothing but a passport to get your first job? That's it. And after that, how successful you'll be, how financially secure, has got very little to do with the piece of paper. Less than 10% has got to do with this. Your financial success, 90% got to do with what? The practical financial skills. That after spending so much money and so much time, schools did not teach us, yes or no? And that's why people end up working hard, but broke. Because they spend all their time on the 10%, thinking it's enough. The 90%, you know what they say? Leave it to what? Leave it to luck. You can't. So this program is your University of Life and Finance, Part 2. Okay? So that's all I have for you. If you want to find out about the program, what is your investment, and by the way, if you register today, enroll today, there is a special promotion for you guys. So you can find out at my booth. And with that, thank you so much. I hope you learn a lot. I hope you go out there and really, really achieve your dreams. Thank you very much.
Thank you, Adam.